Hello friends, I welcome all of you to joining me once again of our another Ind AS session 111, which is joint arrangement. So first of all, I welcome my all respective subscriber as well as viewers, and I warm welcome to my new subscribers as well as viewers who joined me recently. So guys, this topic is very important because this is related to the disclosures as well as the accounting treatment which are related to joint operation, joint ventures. So we will discuss these things in detail. So I have also mentioned what is our today agenda, which it is in next slide. So let's start. I covered today topic in four different sections. So first is introduction. So introduction, we will discuss about what is the joint arrangement, what are the reasons and company prefer to come under the joint arrangement and perform their task or operations. Then what are the basic term and condition which is mentioned in the contract through which entities perform their task, share their revenues. Okay, then I have also mentioned few definitions which are related to what are the joint arrangement, what is the joint control, what is the joint operators, what are the joint venturers. Then second classification, in classification we will discuss about what is the criteria of joint operation and joint ventures, how do we make the classifications. Then accounting of joint arrangement in respect of joint operations and joint ventures, we will discuss about in detail regarding the joint operation accounting treatment related to specific transactions. And then we will discuss about the disclosure requirement which is required in financial statements. Topic number 1, introduction, joint arrangement. So what is joint arrangement? Joint arrangement is nothing, it is a contract or a deed under which the two and more parties are come together to earn the revenue from the activities for which they are agreed to join. Okay, so what are the conditions? First of all, at least two parties should be there who sign the joint agreement. Then they are bound and contractual through the contract to implement the controls. And what are the basic reason for which parties are come together to continue start any specific business? So there are so many reasons. Few are there. That share of risk of project. If one company feels that if I start this project, so I may earn the heavy losses, so what he do, he will share this risk with the other entities who are sound financially and have adequate resources to bear these losses. Okay, then second most effective use is use of technologies equipped with entities. Okay, if one company is using different technology, other company is using different technology, or you can say one company is expertise in assembling process, other companies expertise have a better technology in productions, so they are come together to do such tasks. Then economic of scale, as I give this example, assembly and production. Then eliminate the huge capital requirement to start a project. What company thinks nowadays that they come into the collaboration to reduce the cost of capital requirement, because nowadays to implement or to start a business, huge capital may be required if you have a good business idea. So what they do, they approach to the few good business entity, they are ready to invest their money and earn the revenue by way of percentage. Okay, so here one thing is that the joint arrangement may be either joint operation or maybe joint venture. It is depend upon the conditions, what are the term and conditions defined in the joint agreement. So this classification we will discuss in our next slides. Topic number 1.1, introduction, joint arrangement part 2. So here what are the basic conditions which shall be defined or may be defined by the parties into the joint arrangement. So these are for what purpose this joint arrangement is come into existence, what are the duration, for how many periods, and what type of activity to be performed under this joint arrangement. How many pupils are involved in the governing body to take the decisions which are needs to be taken to run these operations. Then how much of the capital infused by the each party to start the business or to start a specific separate vehicle by the entities. Then what is the procedure of sharing the revenue, assets and liabilities, revenue and expenses, and profit and losses. So this is the most important term, sharing of revenue, percentage of share. Okay, and it is also necessary to determine the control of the entities to take the decisions. So these things are very necessary in the joint agreement. Then 1.2 introduction, important definitions. So first of all, joint arrangement. So what is joint arrangement? Joint arrangement is an agreement or a contractual agreement between the parties that have a joint controls. It may be in written form or it may be some other form, but if it is a separate vehicle like in form of company or in form of LLP, so there may be some bylaws or articles or a charter which define the term and conditions. Okay, then the joint ventures, another definition. Joint ventures means when the joint ventures means the parties have a right in the net of the assets, means when the parties record this type of net of assets by using the percentage as an investment in their books. Okay, they do not you can say this does not have a right to share the assets, liabilities, revenue and the sales on percentage basis. Okay, joint operation, it is in detail step by step process like consolidation process, that as whatever the percentage they are decided in the joint arrangement, they will recognize the assets, liability, revenue or the expenses in their books. So that's why it is saying that the joint venturers have a right in the assets or a obligation for the liabilities based on the share. Okay, here in the joint venture we will only calculate one figure which is known as investment, but in joint operation we have to show it as separately based on the percentage or based on the interest in the joint arrangement. Then the joint control. So joint control is a control which is implemented by the parties. You can say when the joint control by the parties is exist when the decision related to the activity which will be implemented based on the unanimous consent received by the parties who have a control. Okay, if one party has a 50%, 20% share in the joint one party has a 30% interest in the joint arrangement, second party have a 30%, third party has a 40%. If two parties come together and take a decision based on their shares like 70%, 30 plus 40, so we can say yes, they have a joint control. If A and B 30 plus 30, yes, they take the decision and implement the strategy, yes, they have a joint control. So we can say yes, all parties have a joint control, but not a single party has joint control because none of the share has more than 50%. Okay, so this is the joint control definitions. Topic number 2, classification of joint arrangement. So first of all, we take the test whether whatever the contract we have made with other party, whether it is come under the category of joint arrangement or not. So what we do, first of all, we will test that control the contractual arrangement gives all the parties or a group of parties a control over the arrangement collectively. If it is there, yes, we go to the next step. Next step is when the decision about the relevant activity taken or require unanimous consents of all parties or a group of parties that are collectively control the arrangement. Yes, if this condition is also satisfied, then yes, it's a joint arrangement. Otherwise, it is the out of the scope. Collectively arrangement means control 30, 30, 40. We have to keep in mind. Okay, group of parties. Then joint, if it is joint arrangement, now come to the joint operations and joint venture categories. So joint control of the arrangement is when the parties are agreed which are mentioned in the joint arrangement that they have a right in the assets as well as the liability obligation of the assets, revenue or expenses. So they are the joint come under the joint operations. Okay, and they are called joint operators. But in case where the party have a right to the net assets of the arrangement, so yes, we can say these are the joint ventures and the parties are known as joint venturers. Okay, now we have to make the test of joint arrangement assessment process. how can we decide what are the things we have to test to bifurcate whether this is joint operations or whether it's a joint ventures? First of all, if this joint arrangement is not structured to a separate vehicle, not like in the form of company or not in form of LLP, so it is joint operation directly. If it is structured to a separate vehicle, so we have to do some test. What are those tests? First of all, we have to think whether a legal form of separate vehicle is established or not. Okay, if yes, legal form is established, yes, this is a joint operation. If it is not, then we have to test whether a term of the contractual agreement specify that the party have a right in the assets and the party have a obligation for the liabilities. So yes, it is a joint operation. If it is not, then we have to go to the third step. Other facts and the circumstances the party has to check. Party has to check whether the joint arrangement has been designed in such a way that the activity primarily aim to provide the party as an output. Okay, and they are continuously settling their liability relating to the activity conducted by them. If it is there, yes, it is a joint operation. If these three conditions or these three conditions does not fulfill, any of the conditions does not fulfill by the party, so it is a joint ventures. Okay guys, topic number 3, accounting treatment in joint arrangement. So I divided the accounting treatment into two parts. So first part we will discuss about the treatment in respect of the joint operation as well as the joint venture. In second slide we will discuss about some specific transactions under the joint operation, so what should be their accounting treatment, we will discuss in it. So if we are talking about the joint operations, so accounting of joint operation would be done by the entities as they have a separate entities. Okay, so what they will do, whatever the percentage they are agreed in their contract, they will recognize the assets, liabilities, revenue from sales or expenses incurred in joint operation as per their shares. Okay, suppose a company, one party has a 20% 30% shares as per the joint arrangement in the joint operation, so it will recognize the 30% of assets, liabilities, revenue and the expenses in their financial statement. Now for the joint, if it is a joint venture, so it will consider this investment as a net of the assets, means they will consider these recognize interest as an investment by following the equity method. Okay, so for equity method they will apply the principle of Ind AS 28, which is investment in associates under joint ventures. Okay, sometimes it's happened that a party that participate in joint venture but does not have a control, joint control in the arrangement, so it will follow the Ind AS 109 financial instruments. Okay, if it has a significant influence in joint venture, so it will follow the equity method. So these things we have to keep in mind. Okay, topic number 3.1, accounting treatment, second part of the joint arrangement. So here we will discuss about the three basic transactions which may be occurred in the joint operation. First is acquisition of interest, second is sales or contribution of assets, and third is purchase of assets by the third party in joint operations. Okay, so if we are talking about the first transaction, acquisition of interest, when the entity acquire interest in a joint operation, which if such joint operation consider as a business which is defined as per Ind AS 103 business combination, so we have to make the accounting by these following steps. First, measure the identifiable assets as well as the liability at fair value. Okay, if there is any exceptions, so we have to follow the exceptions of 109 or other Ind AS. Then we recognize the acquisition related cost, like we have spent something like legal expense charges for acquisition of any business, so we will charge it during the period in which we have incurred this cost. Okay, but there are few exceptions. If these costs are related to issue of debt, issue of equity or security, so we have to follow the Ind AS 32 as well as Ind AS 109. Similarly, if we are recognizing any deferred tax assets or a deferred tax liability that is arises from the initial recognitions of the assets of the liability, so we will follow 103. Otherwise, if deferred tax liability is related to initial recognition of goodwill, so we will follow Ind AS 103 as well as Ind AS 12 for business combination. I repeat, if there is a deferred tax assets or deferred tax liability which arises from the initial recognition of assets of the liability, so we'll follow the Ind AS 112 income taxes, Ind AS 12 income taxes for business combination. If it is related to the goodwill which arises from the initial recognition, so then we will follow Ind AS 103 to measure the deferred tax liability. Then we have, if there is any excess of the purchase consideration over the net of the assets, so we will consider it as a goodwill. Okay, and similarly we have to test the impairment test for each cash generation unit to which goodwill has been allocated. Okay, so this test of impairment assets would be based on Ind AS 36. Okay, for the goodwill acquired under business combinations. So this is first part. If we are talking about the sales and contributions of assets in joint operations, so if an entity enter into a transaction with the joint operation, so in that case it will treat such transactions as a third party transactions, means does not itself, and it will recognize the gain and losses from such transaction based on the share of the other entities and other parties in the joint operation, not itself, other parties shares. Then it is also, if it is feel that if it has evidence that the such transactions have a reduction in the net realizable value, or it has a impairment losses on those assets, so these losses would be recognized immediately fully, not agreed share. Okay, third point, purchase of assets in the joint operations. So it does not recognize gain and losses from the purchases of the assets in its books, because it will recognize these assets and losses when they sold this type of assets to the third party. Okay, if again, if there is a entity has a reliable evidence whether there is a reduction in net realizable value as well as the impairment losses for those assets, so these losses shall be recognized on the base of percentage of share in the joint operations. Okay, so these things we have to keep in mind. Topic number 4, disclosure in the financial statements. So basically, as per Ind AS 111, there is no disclosure specified, because mostly disclosures which are mandatory in nature for the subsidiaries, joint ventures, associates and unconsolidated structured entities and Ind AS 112, but in AS 111 we have some additional disclosure. So what are those disclosures? So these disclosures are significant judgment and the assumptions which are required in a joint arrangement the entity must have to disclose. Okay, then disclosure of nature and the financial effect on the investment in joint arrangement. So every party must have to show in their balance financial statement about the financial effect of the investment and what type of nature of this investment, whether it is a debt, whether it is equity, and whether it is a joint, considered a joint operation or a joint venture. Then what type of risk associated with the joint venture which makes that joint venture a failure, or which may be create a financial crunch for parties. So these things, these type of risks they have to mention in their financial statement as a disclosure. Then disclosure requirement for Ind AS 112 does not apply to the parties of the joint arrangement that those parties which don't have a joint control. If they have a joint control in terms of significant influence the arrangements, then Ind AS 112 disclosure would be applied. So these type of disclosures are required in the financial statements of entities. So friend, this is all about the Ind AS 111 joint arrangement. I hope you did not get bored in this session. The session is very short. So we will meet again with a more interesting video. So I am planning to release few videos on Ind AS 112, which is our next session, and then after that, on a request few members, I am preparing the video on Ind AS 101, which is first time adaptation of the Ind AS Ind AS in Indian accounting standards. So we will meet again guys. Till then, thank you, bye. Thank you so much. Have a nice day.